Valuation of Shares. Theory Drive. P. Kumarasamy, Assistant Professor, Department of Commerce, UG, Christu Janti College, Bengaluru, Karnataka. Meaning of shares. The capital of a company is divided into shares. Each share forms a unit of ownership of a company and is offered for sale so as to raise capital for the company. Shares can be broadly divided into two categories: equity and preference shares. Equity shares give their holders the power to share the earnings, profits in the company as well as a vote in the AGMs of the company. Such a shareholder has to share the profits and also bear the losses incurred by the company. What is share valuation? Valuation of shares is the process of knowing the value of companies' shares. Share valuation is done based on quantitative techniques, and share value will vary depending on the market demand and supply. Types of the value of shares. 1. Face value or value at par. 2. Market value. 3. Purchase value. 4. Book value. 5. Intrinsic value. 6. Fair value. Factors affecting valuation of goodwill. Internal factors. 1. If expenses are incurred for creation and increase of goodwill, these expenses affect valuation of goodwill. 2. Expenses of management. If special type of expenses are incurred on management and after purchase of business, due to ability and capacity of new purchaser, these expenses will be reduced. Then profits will increase and thus amount of goodwill also increase. 3. Use of patent or trademark. If more capital is to be employed in comparison to profits in order to derive expected profits, then value of goodwill will be less. But if more profits can be derived by investing comparatively less capital, then value of goodwill be more. 4. Use of patent or trademark. If a firm has established reputation for a patent or trademark, it will have goodwill due to it. If goodwill is valued on the basis of patent or trademark, then the period for which patent or trademark can be used in future must be considered. The longer the future period for its use, the more will be goodwill and vice versa. Relation between employer and employee. The better the relations between employer and employee, more will be goodwill. 6. Place. Some places are famous for a particular type of trade or business. If a businessman is carried on at these places, the goodwill is created in addition to other factors due to that place, e.g., locks of Aligarh and bangles of Firozabad, etc. 7. Profits of past years. Past years' profits are taken into consideration for determining future profits. Therefore, past years' profits play an important role in determination of goodwill. 8. Other income. If other incomes are also received in addition to the main incomes of the business, then it must be carefully understood that whether these other incomes will continue to be made in future. If they are to continue, amount of goodwill will be more. External factors. 1. Customer's view. If customer's point of view is good about business, goodwill will be more. 2. Reasonable agreements. If reasonable agreements have been made between concerned business and outsider and all are properly executed, the amount of goodwill increases. 3. Competition. If competition increase, the special feature of a business can be noticed and its amounts to increase in goodwill. Thus, competition is not always bad for increase of goodwill. 4. Intangible asset. Goodwill is not valued like other assets, because value of other assets can be ascertained from the markets. But goodwill is an intangible asset having no shape and form. It cannot be seen and touched, it can only be felt. It has no market value. Its value is determined on the basis of mutual agreement. 5. Special contracts. If a businessman is making profits due to special contracts, then it should be seen for what period these contracts would continue. If the period of their continuance is for a short period, goodwill be less. Need for valuation. 1. When one company acquires majority of the shares of another company, it is necessary to value such shares. 2. When two or more companies amalgamate or one company absorbs another company, it is necessary to form a fair and equitable basis of valuation for transferring the shares. The prices quoted in the stock exchange, if any, do not properly indicate the actual value of the shares. For formulating amalgamation and absorption schemes, a fresh valuation method should be taken up. 3. When a company has decided to undergo a process of reconstruction, to protect the rights of the dissenting shareholders, a fresh valuation of shares should be taken up. The dissenting shareholders should be paid as per the valuation of shares in respect of their holdings. 4. When preference shares or debentures are converted into equity shares, a fresh valuation method should be adopted for equity shares to calculate exchange ratio. It is necessary to ascertain the number of equity shares required to be issued for debentures as preference shares. 5. When a partnership firm is dissolved and the firm is having some investment in shares, it is necessary to value those shares for proper distribution among the partners. When is valuation of shares required? Listed below are some of the instances where valuation of shares is important. One of the important reasons is when you are about to sell your business and you wanted to know your business value. When you approach your bank for a loan based on shares as a security. Merger, acquisition, reconstruction, amalgamation, etc. Valuation of shares is very important. When your company's shares are to be converted, i.e. from preference to equity. Valuation is required when implementing an employee stock ownership plan, ESOP. For tax assessments under the Wealth Tax or Gift Tax Acts. In case of litigation, where share valuation is legally required. Shares held by an investment company. Compensating the shareholders, the company is nationalized. How to choose the share valuation method? 1. Assets approach. If a company is a capital-intensive company and invested a large amount in capital assets, or if the company has a large volume of capital work in progress, then asset-based approach can be used. This method is also applicable for valuing the shares during amalgamation, absorption or liquidation of companies. 1. Income approach. This approach has two different methods, namely discounted cash flow, DCF, or price earning capacity, PEC, method. DCF method uses the projection of future cash flows to determine the fair value, and if this data is reasonably available, DCF method can be used. PEC method uses historical earnings, and if an entity is not in the business for a long time and just started its operations, then this method cannot be applied. 1. Market approach. Under this approach, the market value of the shares is considered for valuation. However, this approach is feasible only for listed companies whose share prices can be obtained in the open market. If there are a set of peer companies which are listed and engaged in the similar business, then such company's share public prices can also be used. What are methods of share valuation? 1. Asset-based. This approach based on the value of company's assets and liabilities, which includes intangible assets and contingent liabilities. This approach may be very useful to manufacturers, distributors, etc., where a huge volume of capital assets are used. This approach is also used as a reasonableness check to confirm the conclusions derived under the income or market approaches. Here, the company's net assets value is divided by the number of shares to arrive at the value of each share. 1. Income-based. This approach is used when the valuation is done for a small number of shares. Here, the focus is on the expected benefits from the business investment, i.e. what the business generates in the future. A common method used is the estimate of a business's value by dividing its expected earnings by a capitalization rate. 1. Market-based. The market-based approach generally uses the share prices of comparable public traded companies and the asset or stock sales of comparable private companies. Data related to private companies can be obtained from various proprietary databases available in the market. What is more important is how to choose the comparable companies. A lot of preconditions to be kept in mind while selecting, such as nature and volume of the business, industry, size, financial condition of the comparable companies, the transaction date, etc. There are two different methods when using the yield method. Yield is expected rate of return on an investment. They are explained below. 1. Earning yield. Shares are valued on the basis of expected earnings and the normal rate of return. 1. Dividend yield. Under this method, shares are valued on the basis of expected dividend and the normal rate of return.